Hello, government and economics. You're lucky if you take both because this lesson kind of lined up perfectly. So if you're in Gov and you're getting this first, you only have to do this set of notes once because I'm going to use the same screencast for economics to go over monetary and fiscal policy. Thinking about the government and the economy right now, there's a lot going on because of the COVID-19 pandemic. Um, Taxpayers, it was just announced by Steve Mnuchin, the Treasury Secretary, have an extra 90 days to pay their taxes. The stock market is down. Obviously, it's been dropping quite significantly. Oil prices actually fell to the lowest level they've been at in 18 years. So there's two ways to look at that. Cheap gas, right? But this is Silicon Valley, so a lot of you have electric cars. And it could affect your portfolio, your savings that you've invested. There's a stimulus package in the works. So that's going to relate to our discussion of fiscal policy. There's two parts that we know of and one part that we're unsure about for this government attempt to stimulate the economy. They're funding research on vaccines to fight the pandemic and things like that. The next part is sick leave and unemployment and supplying people with food. And then the third part, we're not sure. It could mean that all working Americans could get a check in the mail. So we'll talk about that when we get to fiscal policy. And, we're really just in an unsure time. So we do have a mixed market economy. So there is somewhat of a free market, but the government will step in and intervene. So that's what we're going to discuss today. So just in general, thinking about the budget, the president would suggest a budget. Congress, in the end, has to pass it through with a spending bill, an appropriations bill, and there are some non-negotiables there. The entity in the bureaucracy that helps the president create this budget is the Office of Management and Budget. If you just look here, this is fiscal year 2017. On the left is mandatory spending. So these are things like Social Security, which provides retirement benefits, survivors benefits and disability payments. Medicare, that's a non-negotiable. And this has already been defined in the past through legislation. It would take a vote of 60 in the Senate to get rid of any of these what they're sometimes called entitlements. On the right is discretionary spending, where the president, Office of Management Budget can suggest what they want. They can dial it up or dial it down in terms of military spending, research, etc., education. So that is there for them to play with, whereas the mandatory spending is already decided. You could have a balanced budget. That is not a thing we're good at. You could spend less than you have. Also, definitely not a thing we're good at. Or you could be deficit spending, where you're spending more than you're actually taking in. And where are we borrowing this money when we're spending on deficit? We're borrowing it from investors and other countries. We're borrowing from ourselves, from Social Security and the Fed. And I took this screenshot on the bottom right yesterday or the day before. And that is our current debt. $23 trillion is really quite a number. So you know that most of our money comes from taxes. The 16th Amendment allowed for, because we had taxes on labor, like the direct amount of money you're taking in the past, Civil War, for example. But now it allows any income. So that could be your wages, but it could also be dividends, meaning the money you're earning from investments or rental properties, etc. So let's talk about fiscal policy. That's the first way that the government can influence the economy. If we're in a period of growth, there can be problems like inflation. We measure that by looking at the business cycle. So we measure the gross domestic product, all the money spent in goods and services in 1 year in the United States. So growth can become problematic because then prices rise and people things get out of control and people stop being able to afford things. We use the consumer price index to measure inflation. So if that's going on, or if we're in a recession or a contraction, then we can have problems with unemployment, and we would be able to see that indication from the unemployment rate as well as a plummeting GDP. So what Congress can do is taxing and spending. If we're growing too quickly, they can increase taxes. The GDP is in a expansion. If we're on the verge of a recession or an extreme period of time, which would be 2 years for the depression, 6 months for a recession, then they can spend. So that's what I was talking about, that stimulus bill that we were discussing in the beginning. I think it was probably like 2007-ish. I can double check that one for you. When George Bush was president, this happened 2 times. He sent people checks for $300 to stimulate the economy. And there were other incentives. There was something called cash for clunkers where it was a two-part spending policy where you could sell your car. They would, if it got a certain gas mileage, like my old Jeep qualified because it got horrible gas mileage. It was good for the environment, and I got a little bit of money for it. I think it was like $3,000, was definitely not worth that. And then I bought a new car. So it helped the environment, stimulated the economy. Some people are proposing that they send everyone $1,000 check right now. So fiscal policy is taxing and spending done by Congress to influence the economy. Monetary policy is the other arm of our, financial, what am I trying to say? Who knows? But the Federal Reserve is the entity, and it's part of the executive branch, but it kind of operates on its own. It's run by a chair, and there's a board of governors and the FOMC. So their goal is to control inflation and encourage full employment. So how they do that is, you'll hear that the Fed is printing money. They're not actually printing money. The Treasury Department does that, but they are influencing the available credit in banks. So there's a lot of way that they do that. They make rules for banks, first of all, and they can loan money to banks, because when you and I need something, we go to the bank and we get loans. The last big purchase I made was a car. But people want to buy varying things, so they have to go to banks to get loans. So the availability and the more likelihood that people will go to the bank would determine on the interest rates. So the Fed can dial up and dial down interest rates. Banks can borrow from the Federal Reserve, and therefore, if they have more money, they have more to give out. They set reserve requirements in banks. So it stops things like bank runs. They have to have a certain amount at any given time. And they also do something called open market operations. You'll hear about this where, the Fed is in an easing period. So what that means is that they're buying treasury notes. You'll sometimes hear it'll be 10-year T note, and that's a 10-year treasury note that you can buy and you earn interest. It's a pretty solid and reliable investment. It's not going to get you huge yields, but if the Fed wants to put more money into the economy, they can actually buy treasury notes and you can get the money earlier than you originally thought. You can always sell it back to the Fed if they're trying to take money out of the economy, or you can just keep it. And that's that. But, the Fed is the banker's bank and they influence how much money banks have and interest rates to lend to you. So that's how they can kind of dial up or dial down the economy. And if you think about it, the whole concept of this is that everybody wants money at all times, but is it available? And are banks willing to give it to you? So the Fed can influence that. We're going to play a game in Zoom called Is It Monetary or Fiscal Policy? So have your fill in the blank notes out when we do our Zoom call, and I'll talk to you guys soon. Bye.